been doing this in this industry for 35 years, and I think of all the jubilant points in time where clients were so happy they were making so much money, and I'd say, don't get too excited. And all the times when the markets were in turmoil and the world's coming to an end, and I said, don't get too depressed. And the good investor is the one that walks in with a thesis, an investment thesis, which means typically an allocation, and if their money outside
a strategy of how they're going to manage their money.
Yeah, and then if it's outside an IRA, a tax program that actually sits on top of that to make it as tax efficient as possible, or if you're high net worth, a gifting program. But whatever it is, a strategy, and the markets come and go, and the political environment would change, but you're not reacting.
No tariffs, all that stuff comes and goes.
Yeah, you're not reacting to outside forces.
But Pat, it's so tempting to think, this is going to happen. Well, because you turn on the CNBC or Fox Business or whatever else is out there. Does Money Magazine still exist?
I actually
I don't know. Or Market Watch or whatever it is. Articles, they write articles and have stories and packages on the news for what? What purpose?
To draw your attention.
To draw your attention, right? We all understand how it works, so they can sell advertising. That's their product. They got to deliver eyeballs so they can sell to their advertisers. So they're constantly having stories about, how do you what's the right thing to invest in now?
What's the next big thing? And this is
all stories like that. How the wealthy are investing now. 4 things you can do. All that.
7 things, 9 things. It's never 28 things you should do to get your financial house in order.
I'd like one.
1 thing. 7-minute abs. But I go back to the creation of the Dow Jones Industrial Average.
Late 1800s.
It was, what was it? 11 stocks. What were they consisted of?
9 of them were railroads.
9 were railroads.
What else could there be?
Right?
What was the most important technology of the time?
What else was?
Do you think how railroads transformed our country?
Oh, incredible, right? That was the newest technology. What people fail to understand is that many of the railroads went bankrupt, and many of them did very, very well.
That's right.
Right? They did very, very well, and many of them went bankrupt. So what does that tell you?
And the average investor in railroad stocks in the 1860s, 1870s lost money.
Yes.
Because of the amount of bankruptcies.
Because of the amount of bankruptcies. But if you had a diversified portfolio of railroad companies, and as new technologies came online, you added them to your portfolio while keeping your existing, that you did well over time. So the Dow Jones...
What would it come out at? Was it 100? The index number? The numerical?
Yeah, I believe it was 100. I think it was 100.
I think it was 100.
Yes, it was.
And we're at what, 44,000, 45,000?
And it's not a weighted average either, unlike the S&P 500.
Today it's 30 stocks.
So today's is 30. How many railroads are in there?
I don't know. I haven't looked at the Dow. I don't probably pay any attention to it. I have no idea. Actually, I have no idea I can make some guesses.
Yes. But the point being is don't get too excited about the latest, greatest thing. Just don't.
Both on the positive and on the negative.
That's right. Don't feel like you're missing out on this or missing out on that. Look, And
it's funny, Pat, so we get tempted sometimes to have more commentary on the current market stuff. And then we're like,
what's the point?
How is that going to be helpful to people?
Right. Because, look, especially...
And there's enough of that out there. You can get...
The closer you get to retirement, the more your interest should be in not being poor than it is in getting rich.
Maintaining your standard of living.
Maintaining your standard of living.
That's what most people are mostly concerned with.
Right.
You get to retirement, you got a couple $1 million saved. And boy, it'd be great if it was 10 million, but it's probably not going to be 10 million. I just want to make sure it doesn't go back to.
So you had clients,
0.
I had clients during 2 market cycles where there was great exuberance. One was in the housing and the other was in tech. And against our advice, we had clients that permanently ruined their financial well-being, their lifestyle by putting big bets into those. I still remember one guy said to me, "You don't get it, Pat. Everyone's going to move to Florida." Bought 7 houses and the only thing that was left when it was done, he bought 7 houses in Florida, condos.
It's a client of yours?
Yes. The only money that was left after the whole thing was over was the amount of money that his wife left in an IRA with our firm. That was the only money left.
Because he had debt on them all. I remember, Pat.
Or the tech, same thing.
This was in the year 2000. So 1999, if you're 55 and older, you probably remember it, particularly if you had any money saved at that time. If you're younger, like the market was on fire the late 90s. And everything was .com. If your company had a .com part of the name, you had a tremendous valuation. It was just crazy. And in 1999, the NASDAQ returned, I believe it was 85% that year.
It was crazy.
Okay? NASDAQ goes up 85%. I remember 2 lessons from this. NASDAQ goes up 85%. The S&P was up about 20% that year. I had a client come in like January, February, was upset. He says, "Scott, you're obviously not doing a good job and paying attention to this portfolio." And I'm like, "What are you talking about?" And we had about, I think it was account was up about 20 or 21%. We had the same return as the S&P 500, even though we had bonds in there. But he says, "Here's what I'm frustrated about. You had real estate in this portfolio." This was in 2000. You've got real estate in this portfolio. I don't know why you have real estate in portfolio when the stock market's doing so great. So he fired me. So I'm taking my money elsewhere. I'm like, well, because you don't have enough technology in the portfolio. Well, I think we all know what happened after that, right? Tech stocks, how far did they fall?
They were down 80-some%.
Disaster. And what happened with real estate?
It went up.
It had the best 8-year run as ever.
It went on a tear. So, before we go to the calls, remember, this
I'm going to give you a couple more stories.
Shall pass.
Another story.
Good and bad.
Someone was bragging about, they had a side account they were investing in tech stocks. And they said, "Scott, my account trading, I made 78% last year. 78%. And I said, "Wow, you did kind of poorly." He looked at me. I said, "The index did 85. You did all that work for nothing. You cost you money for all that work. You should have just bought the index and went out and golfed every day or whatever."
You have a bedside manner that's incredible.
I don't think I quite said it like that.
It's amazing we have any clients at all.
We'll go back but it happens on both ends, on the euphoria, and I remember during the financial
on the
crisis,
downside.
I remember the financial crisis. This one client, and look, we are pretty highly diversified. And when downturns come, one of the things that's helpful is looking at your portfolio. All right, what's actually not in stocks? Like, what's protected? What do we have in conservative bonds? Like, what in cash? What do we have outside?
And especially if you think especially if you're taking income now, or you believe you're going to be taking income in the next few years.
So this is a particular client had been retired for a few years. He'd been a client for a number of years before this, many years actually, and he was really nervous about the markets declining. And he called like every 3 weeks, and I'd tell him the same thing. I'll call him Steve. Steve, like, you got to stick. Like, we've got 62% in stocks, whatever the number was. Like, we're going to ride this thing out. They always come back. I try to so he called about every 3 weeks. And one day he calls and didn't want to speak with me. Talked to someone in our trading team, and did a trade without
your
like. I'm going to do what I want to do anyway. And of course, he missed out on the recovery. And the Dow, what did the Dow fall down to? 7,000 or something? It said 45,000 today.
Your memory is much better than mine. And so missed a large portion of they did get back in at some point in time, I'm sure.
But not to the extent.
Yeah,
he ended up needing a reverse mortgage to make his monthly note work.
Well, but you understand how emotionally hard it is to stay invested.
I do understand. That's why it's important to be wide-eyed on your portfolio today. Like, what will come in the next 20 years? If you got 20 years left of life expectancy, have a pretty good idea, like, what's kind of, we'll have some bear markets, we'll have some nasty downturns, we'll have some recessions again.
That's right. And we'll have some great times.
And we'll have some great times.
This too shall pass.